Hello everyone and welcome to ICA Vision 2020. We're delighted that more than 500 of you have registered to join these events, 4 events spread over 2 days. In a moment I'll hand over to Jerry Marshall, who will be your host for this first session, but before that I'd like to particularly welcome everybody to the event and make special thanks to our sponsors. Their names are on the slide in front of you, and without their support, we wouldn't be able to host this event today. Jerry Marshall, over to you for the first session about the context of global trade. Thank you.
Thank you, Bill, and good morning to everyone. This is the keynote session for ICA Vision 2020. My name is Jerry Marshall. I'll be hosting the session. And we're going to focus on how the trading environment for raw cotton and textiles and garments has been changed by the remarkable events of the past year or so. The pandemic, obviously, the trade war, political uncertainty and turmoil in many countries. These problems are clear. The question is there room for optimism? What are the new opportunities that have been created by this? And what are we just going to have to learn to live with? Before I introduce the panelists, I want to run through a little bit of information about how this will work. I'm sure most of you are well familiar by now with how Zoom works, but please feel free to use the chat facility at the bottom of your screen. You can communicate with the panel, you can communicate with each other privately. If you have a question for any of our panelists, or you have a question for the group as a whole, please use the Q&A feature there at the bottom. We're going to get to as many of your questions as we have time to do. We are on a strict timetable. We need to finish this at 1 o'clock UK time, which is about 56 minutes from now. So don't wait too long to ask your questions. We're going to start with some general remarks by our panelists. First up, we're going to have Marcus Garvey from Macquarie Bank, based in London. Marcus is the newly appointed head of metals and bulk commodity strategy. He joined Macquarie last year. He is responsible for analyzing cross-commodity macro themes and trading dynamics while also leading coverage for precious metals at Macquarie. He's been in the business quite a few years. He's got extensive experience across precious and base metals, bulk commodities. He's been a principal analyst for each of these sectors at different points in his career. Marcus has a Master of Philosophy from Oxford in Modern Chinese Studies. So I imagine he's got some good perspectives here on some of these issues, as well as a BA in Economics, first class from the University of Durham. Marcus, you're on.
Thanks very much, Jerry, and thank you for having me. I'm conscious I know very little about cotton in the context of this event, so I'll try and keep my comments quite general and hopefully therefore relevant, and obviously we can go into specifics on anything in the Q&A. In terms of the background points I'd make on the macroeconomic environment, in the industrial commodities that I focus on, there's been a lot of skepticism about the pace and the scale of the recovery that we've seen in prices since the lows hit around sort of March, April. But I think actually, if you look at both really kind of the nature of the recession and the recovery we've had, and the policy response that we've had this year, actually we think there's a lot of fundamental justification for the way that many of the commodities have behaved. If you think about a normal recession, it tends to occur after there's either a financial or an economic imbalance, and then you get into a position where end demand starts to slow and you go into a downward spiral. Of course, this year is completely different, and we had a recession that was really mandated by lockdowns, first in China and then spreading throughout much of the world. Since then, however, if you look at the way that we've recovered, it's a completely different process to what we've seen after previous recessions, and it's also been much faster. So if you look at, say, industrial production in global terms, after the great financial crisis, 2008, that took more than a year. In many countries, it took more than 2 years to recover. This year, we're already back at the pre-crisis level after about a quarter and a half. The composition also of that recovery has been very commodities intensive, because we've seen China leading the recovery and leading it with a very investment-driven growth model. So even though China is normally investment intensive, actually this year that has been kind of even more than normal the case. Year to date, for example, China's economy is actually in positive territory, but only just. It's up just under 1% year to date in GDP terms, but investment is up almost 4%, and then consumption is still down on the year. So we've seen very, very strong investment demand, which has been a big pull for various commodities like steel, iron ore, copper. The other thing is that if you look not just at China, but globally, goods demand has been incredibly strong. So if you take the US, for example, durable goods demand is actually up 10% on where it was before the crisis kicked in. So we have actually seen genuine increases in demand for many things. In part, this reflects the policy response we've had with things like checks being mailed to people quite literally directly in the post in some countries, obviously the US most prominently, but also the way that people have responded to lockdown. So services demand is still very weak. And in many cases, that's people's choice, but also obviously in other cases, it's not because of policy decisions. But actually goods demand is up on the year. And so we now, from a kind of glass half full perspective, actually have a scenario where if you look across global manufacturing, because goods demand has been strong, and although industrial production has recovered, it has lagged. In many instances, inventories are quite low through production chains. So the kind of glass half full argument on a growth perspective is that actually there's scope for general restocking through many manufacturing industries, which can support industrial production continuing to grow into the new year. Now, clearly, there's numerous risks to this, not least COVID second waves, particularly in Europe, and to an extent a third wave in the US. But actually, I think we're of the view that we think growth continues to recover into the new year because we've so far seen consumers actually being very resilient. And if you look at consumers' response to the crisis so far in terms of increasing their savings, the support that people have received hasn't by any means already all been spent. So actually there is a lot of potential for particularly developed market consumers, developed market consumption, I should say, to remain robust into the new year and to support that industrial cycle. And also, in the case of China, particularly as the biggest part of the EM bloc, consumption has lagged the recovery. As I mentioned earlier, it's been very investment driven, but it is starting to pick up. And we saw, particularly in the early parts of October, some noticeable improvements in kind of leading indicators of consumption there. So that's something that I think gives us kind of a reasonably rosy view in terms of at least the sequential path coming from what's obviously been a very challenging year. In terms of a few sort of other themes that I think are going to be quite relevant before I go on to trade, clearly US election is front and center. From a short-term growth perspective, and particularly from a commodities demand perspective, I think the most meaningful thing really is what kind of a fiscal package do we get? Obviously, the chance of a package before the election now is very slim, if not effectively dead in the water. And what's the composition of that package? So if you get a package which is, for example, sort of north of 2 trillion, possibly above 3 trillion as the Democrats originally were looking for, and that package is also very much focused on direct fiscal support for people and for local states so that the money is likely to be spent, it should be supportive of goods demand in terms of the short-term cycle. If, however, you get a smaller package, or you get something which is more focused on tax cuts, then actually it's more likely that more of that money is going to be saved because it would accrue more to wealthier income groups who are not in a position where their marginal spending is likely to rise as much. And so it would be less meaningful both for growth and particularly for commodities demand. So from a demand perspective, if you look at sort of stated policy intentions, a Democrat blue wave is probably the biggest thing that gives you a short-term real demand support for commodities without getting into what happens over kind of a longer term horizon. I think one of the things that follows from that a lot of people have been focusing on in industrial commodities world is the potential for higher inflation, and for that to be something that lifts commodity prices in general terms because of the long-standing relationship between commodity prices in aggregate and inflation. I think we need to be a little bit careful there between correlation and causation. There is clearly a correlation, but actually the causation really stems from underlying changes in aggregate demand, in the sense that unless you have instances such in the 1970s where we had oil price shocks because of supply, really that correlation stems from strong underlying demand, in the sense that if we have good demand and you see industrial production increasing, and you therefore see strong demand for commodities and you see stronger demand for labor, you get the kind of virtuous self-reinforcing cycle on the way up, where everything is moving together and those underlying markets are tightening together, and the same on the way down. So when people ask us about the inflation commodities relationship, I think really what we're saying is, what's our view on demand? If you think demand is going to be good, then you are likely to see higher inflation and you are likely to see stronger commodities prices, but vice versa in terms of that demand view. I think that's the key thing to focus on there. In terms of trade, I think there's a couple of points that I would make. One thing is between sort of the differences of say, a potential Biden approach versus a Trump approach. Clearly, Biden's talked a lot about multilateralism and the idea that tariffs might be sort of taken off the table in a Biden administration versus the continuation of a Trump presidency. One of our views is that if you get that, irrespective of what it may or may not do to trade flows, from a market reaction perspective, it probably contributes to dollar weakness because it gives you a stronger Chinese yuan. So we think if you get a Democratic blue wave, for example, or at least you get a Democrat in the White House, you're likely to see a stronger yuan, and I think that's something that obviously will be get a lot of attention next week. Beyond that, though, I think we need to be a bit cautious about reading too much into how different administrations are going to change things in terms of trading relationships, and particularly the US-China relationship. You know, the Pew Center has done some quite interesting surveys, not just in the US, but globally, of public opinions towards China. And if you go back to, say, the early 2000s, many countries, if you look at, say, US, UK, Australia, Germany, South Korea, had public sort of views on China that were positive, ranking above 70%, and views negative being, you know, commensurately either there's some undecided and then the rest on a sort of 20 handle. Nowadays, you're actually in a position where in many countries that's completely reversed, and unfavorable views are above 70% in most large trading nations. So even if you get political change, while that attitude is in place, I think it's going to be something that remains a theme where kind of Western and other non-China governments are under local political pressure to take a slightly different stance to the one that they might have had in the past. The other thing I'd add on trade before I wrap up, and I'm conscious of time, is on the China side themselves. I think it's important to look at how they're dealing with specific trade issues. And in commodities, there's a couple of interesting examples where we're going through their planning or pre-planning for the next 5-year plan at the moment. And there has been instances this year where they've strategically stocked certain industrial commodities. So, for example, copper or maybe molybdenum, there's a smaller market that some people will be less aware of. They've bought more than would make commercial sense if you look at what has been sort of a relative price in China versus ex-China, whether they would have wanted to import. They bought far more than I think you could rationalize. And that speaks to the idea that in certain commodities, they are looking at strategic stocking. However, in others, where they have a good domestic resource base and don't necessarily need strategic stocks, such as coal, they've actually been sort of much more aggressive on the front foot in terms of using it as a sort of political lever. And for example, they have been restricting imports of Australian coal this year. And so that is something where they're using sort of trade to play politics. And then finally, the other thing I'd add is I think within our markets, we're seeing ESG, particularly in terms of its impact on supply chains, gaining more and more prominence. And one instance I think that illustrates this quite nicely is that in the nickel market, which I'm sure people will be aware is key for the future of electric vehicles because of its use in batteries. There are several projects being developed in Indonesia at the moment that should supply the automotive chain. And they were all planning to use methods for dealing with their overburden from the mine that would have resulted in placing it underwater. But this doesn't have a great environmental reputation. And so they've all now, due to pressure from the automotive industry, said that they will go for different methods for disposing of that material that are deemed to be more environmentally friendly. Not to sort of pass judgment on that, but I think it highlights that the importance of supply chains for people is going to take on more and more prominence over the next few years. And it's something that we're seeing really across our markets on the industrial metals side. And I'll finish there. Thanks, Jerry.
Well, thank you, Marcus. I think we're going to be getting some questions. I see we already got one coming in. In order to make sure that we have time to do this right, I think what we'll do is go ahead with our next two presentations, and then we'll come back and do questions after everyone's done. Our next presenter is Dr. Rabonna Huck from Dhaka. She's a businesswoman and a poet, and has been named by BBC, was featured in the BBC program 100 Women around the world. She is the managing director of the Mohammadi Group, family business conglomerate. The business began exporting ready-made garments, and since diversified into software, digital distribution, real estate, power generation, and television, actually. She is the first female president of the Bangladesh Garment Manufacturers and Exporters Association. Her poetry book in 2006 won the SAARC Literary Award for her book entitled Time of My Life. She's the former CEO of TV South Asia, a collaborative platform of South Asian electronic media based in Kolkata. She sits on the board of trustees for the Asian Institute for Women, Asian University for Women, excuse me. She holds a PhD in English literature from Jadavpur University in Kolkata and an MA in English from East West University in Dhaka. Dr. Huck was married to Anisul Huck, the late mayor of Dhaka North City Corporation. Dr. Huck, we look forward to hearing your remarks. Thank you.
Jerry, thank you for an elaborate introduction. I don't know whether I deserved all of it. You may hear the cars moving on the streets, but I'm sorry, I live in a city which is riddled by traffic. Thank you for giving me the opportunity to address the audience. I can only tell you this much, that yes, the context of global trade has changed with COVID. As much as our lives have changed, so has our scenario of trade. And there's no denying the fact that we've all woken up to new realities, which are harsher than before. And as far as manufacturing goes, this is what we do in Bangladesh. So 84% of our export comes from ready-made garment sector revenue. So you have to understand that everything depends on garments. And there's a multiplier effect. So we have 4.1 million workers to support. At the same time, they support at least 20 million people. So if we take 5 persons in a family, then they directly support 20 million people. That's a lot. So it's important for us to be alive, and it's important for us to be sustainable. COVID has brought along a lot of realities and has placed it on our platter, which are actually difficult to gulp. We woke up one fine morning and found our orders canceled, deferred, and in question. So we didn't know. There was a lot of uncertainty. As much as we realized that the markets in the West were obviously also dwindling, but we didn't know how to react to it, because we depend on it. We depend on the Western markets, and very unfortunately, we haven't grown strong ties within our own region. So, we haven't really been looking inward so far. So over-dependence on EU and the States and a few other markets, but well, especially on these two, have been our steady features. And so far, we've had serious backlashes from both the markets because West also was very badly affected by COVID, and with all the uncertainty everywhere, most of the buyers came back and said, sorry, I mean, we have to evoke our force majeure clauses and all the orders are canceled. So we literally had uncertain landscape in terms of payment to our workers, because Bangladesh pays $423 million only as wage to these workers. So we were at a loss. We didn't know what to do. So the extreme vulnerability of the sector was exposed, and that we weren't prepared for it is probably the least that I can say. Yes, the government was extremely supportive. Honorable Prime Minister announced exceptional stimulus packages where we got to take the loan in very, very low interest, as low as 2%. So, policy response was brilliant and very quick. And that sort of saved us from doom. If we had to worry about how to pay our workers for 4 months, then we wouldn't be able to actually concentrate on our businesses. We wouldn't be able to restructure them. So it was a huge relief for us. So with that incentive or with that stimulus package in place, we slowly started negotiating with our buyers, brands, and retailers. And at one point, everyone turned around a little bit, and most of the orders were again, reinstated. But it came with a heavy price as well. Some parts of the order were restored. Some were deferred indefinitely. Payment terms were all 120 to 180 days deferred. Some people even told us that we don't know how we'll take it and when we'll take it, but we'll take it. So we counted on that and slowly started building bridges back to the buyers. And so far, touch wood, wherever the wood is, we've been lucky, we've been good so far. But with the second wave coming in again, we don't know where our exports will be and how badly we'll be impacted, because in March and April, we literally suffered an 86% and a 62% drop in our exports. So Bangladesh exports around $34 billion. So, it was just a no-brainer where we would be this year. And we've already suffered almost a 12% dip in our export. We do a monthly and actually a daily monitoring on export, which is probably not very healthy, but we still do it. So this month, as of 25th, we've had quite a significant dip of around 9% based on, year-on-year basis. So we don't know where we are going, but I can only tell you that we have to revisit our contracts rationally, because our contracts with our buyers are pretty loose. We do get letters of credit, but mostly we also trade in, absolutely in open terms on the basis of telegraphic transfer. So it's difficult for us to hold our ground. And also with this whole new trade scenario changing, an interesting part, Jerry, has been the discussion around sustainability. I mean, it's always slapped on us that we need to be sustainable, and there are so many prescriptions coming our way. But you know what? This time, COVID literally proved to us that we must have sustainable sourcing practices, without which the vendors feel very vulnerable, are exposed to extreme miseries. So it's a question of not only sustainability from the part of the manufacturers, but it calls for a global collaboration of sustainability, and everybody needs to be sustainable in their own platforms. And also, very often we do a lot of mudslinging, and we say, we blame it on one another, and we say, buyers could have done better. Buyers tell us that we could have done better. But you know what? It's time to be on the same platform, including the labor unions, including the activists, because it's not reports that matter. It's not the critique that matters. It's addressing such scenarios is what such actually addressing disasters is what matters most, because COVID has changed our lives forever. And going forward, even if there is no COVID-19, there'll be something else. Fear has set into the mind of the consumers, of the manufacturers, of the brands. So as far as we are concerned, we will be living in relative uncertainty for at least a year and beyond. And we don't know what the consumer is going to be buying next. We don't know whether the consumers are going to buy generously, or are they going to be more conservative, more conscious about what they're buying. So we don't know. All we know from Bangladesh is that consumerism must also be tested by responsible behavior. So responsible consumerism is what we ask for, responsible sourcing is what we ask for, and responsible manufacturing is what we commit to. So all three parties together, we need to be in it together. Our stories must be told to our consumers. And being in Bangladesh, all I can say is it's important for us to encourage consumption responsibly, because if you buy one less jacket, you know what, our workers suffer. But what is it that we are offering you? If it's acceptable, if it's of good quality, if it's coming from the right sources, then you know what, you should be buying. Because with every purchase that you make, you impact the lives of the workers that we have here. And 80% of our workers are women. So I would like to urge everyone listening in tonight that it's important for us to be in it together, and that there's no sides here. We are all in it together, and we need to collaborate. So my standard word is always two things. I always talk about co-opetition, so collaborative competition. And I always say it's about Bangladesh. I keep on saying that, you know, because we have so many green industries here, and we have the largest numbers of LEED certified gold and platinum factories in the world. So it's important for us to come off with a slogan of #GoHuman, Go Green. Thank you very much.
Well, thank you, Dr. Huck. That was very interesting, and I particularly appreciate you emphasizing the human aspects of this. You know, so often we get hung up in statistics and numbers, and can lose sight of the fact that 20 million people are directly depending on this industry and on our ability to enforce contracts and to be good partners. And really, we certainly appreciate that. I'm sure there's going to be some questions for you later. We're going to move on to our third presenter, Colin Ales. Colin is the head of cotton for Glencore, based in Rotterdam. He began his career back in 1995, working with me, actually, in fact, at Cargill Cotton. We worked together for 12 years. His major focus at that time in Liverpool was trading African origin cotton. In 2006, he got posted to Johannesburg, where he was running Cargill's Southern and Eastern African ginning business. In 2008, Colin moved from Joburg to Memphis, the global headquarters of Cargill Cotton, to become the global trading manager. And that's a position he held for 3 years up until 2011, when Cargill sent him to Geneva to head up the sugar trading. In 2012, after 16 years at Cargill, Colin left and joined Glencore to head up its cotton business. And again, he's based in Rotterdam. He's an alumnus of LSE. I worked with him, like I say, for 12 years at Cargill, and I can honestly say he has one of the sharpest minds you'll encounter anywhere in the world of cotton. And I think I appreciate you being here, Colin, and I'm going to turn it over to you.
Well, it's very kind of you to say that, Jerry. I'll do my best not to let you down. But as I'm sure all the attendees can imagine, I do have some prepared notes. But before I get onto those points, I would just like to thank Rabonna for her comments, because the last sort of topic on sustainability really resonated strongly with me, because I think that you know, for so long, when the market's been relatively stable, you know, we've thought about sustainability in terms of kind of ground husbandry, bringing people out of poverty. You know, and obviously there's been various NGOs that you know that all of us as traders have you know, have joined up with and subscribed to. But I think, you know, the one thing that COVID did do is it showed that there's a much sort of broader scope of sustainability, and that's about the asymmetry of power within the supply chain. You know, and it really highlighted the hypocrisy of, you know, some of the household names that we see on the high street. You know, that they really, you know, they walk the walk, but they don't talk the talk. You know, and I really hope that one of the positives that might come out of the experience of the last 6 or 9 months, you know, is a bit of an evening up of the playing field there. So you know, that was very insightful for me. Thank you, Rabonna. Okay, so I am completely unqualified to comment on you know, on the downstream stuff and retail stuff. So I'll swing back to the things that hopefully I might have a bit more insight into, and talk a little, partly anecdotally, and about the sort of experience that I've had and Glencore have had in navigating through the last year and through the pandemic and the lockdowns and the, you know, as Marcus mentioned, the subsequent loosening up, which I think has probably been a bit more rapid than most of us anticipated, and that's obviously all to our benefits. And what I would say about all the things that I'm going to mention is that none of them are necessarily new because of COVID, but they are kind of adaptations that we've made because of what happened with the pandemic. And so the first item I'd touch on really is the way that we have viewed our counterparty risk. And this really is a, you know, it's a storm that's been brewing probably for 2 years. And I think that COVID was really the last, the straw that broke the camel's back. You know, and all of us as merchants have been dealing with high price contracts. You know, and the US-China trade war certainly was a large contributor to it. But we were struggling through. We were getting LCs from various counterparties who were in trouble. And then when the market fell in the end of Q1 this year, you know, that really was the end of it. When the front month went down to 48 cents, there was, you know, contracts that all of us had in our books that we had hoped that might get performed, and I think we just had to, you know, we had to face the reality that they were, you know, they were lost causes, and you saw that in the number of arbitrations that went to the ICA. And how much has that cost the industry? I think we can conservatively say, and I'm certainly not going to mention any names, but I know what our experience is, and I've seen numbers that have been published on some other companies' accounts. And I think over the last 2 years, undoubtedly, more than $200 million has been lost in contract defaults, lost from the merchant's balance sheet. Wouldn't be surprised if it was 50% more than that. So what does that mean as a trader going forward? Well, obviously, you know, once bitten, twice shy. Our approach to counterparty risk is massively elevated compared to what it was 12 months ago. The amount of due diligence we're doing, not just on potential new customers, but existing customers, has gone through the roof. And it's very difficult for me to, you know, to push back against a finance department or a risk department when, you know, we've taken 6-7 figure provisions against counterparties that haven't performed. And so looking forward to the next 12, 24 months, I really don't think that's going to change. And I think that the processes that we as merchants have to onboard new customers and new suppliers, I think is going to be much more onerous. And although it's been proven over the past, in the 25 years since I've been in the business, that we do tend to have short memories, I think that this one might stick in the throat a bit longer, and that the possibility of doing new business with new counterparties on a deferred basis is going to be much, much reduced. And so possibly we're going to see more activity in the spot and the prompt market than we are in the deferreds. And certainly that's the case at the moment. I mean, it's very easy to sell for 2 weeks shipment. It's very difficult to sell for 6 months shipment at the moment. Next point I'd like to raise is more of a sort of macro one, and that's about the political interference in commodity markets and in cotton specifically. I mean, we've always dealt with a fairly heavy hand by various governments around the world, but with the sort of the rise of populism in a lot of countries, particularly the US, a more nationalistic agenda, and then obviously with that being put on steroids by the individual responses that countries have had to make in response to the pandemic and the various lockdowns, I think that it's fair to say that we're going to see increased involvement and disruption by governments around the world. And if I just tick off over the last year, what's happened and where we stand now, we've had the US loan extended. We've got the phase 1 China-US trade deal being kind of executed or otherwise at the moment. We've got, as Marcus mentioned, the US and Australia having this kind of underhand, tacit trade war, trade tensions, and Marcus mentioned that in respect of Australian coal, but we can add Australian cotton to that. I mean, there's no official ban, but there's clearly a strong undercurrent of encouragement by government entities in China for the private and government importing bodies not to use Australian cotton. We've seen a promise to support Xinjiang prices by potentially buying 500,000 tons of Xinjiang cotton for the Chinese State Reserve. It appears that the State Reserve are restocking. I mean, that's certainly the case with other commodities, and we've seen State Reserve relatively very active this year, and they were also active a little bit pre-COVID as well. India as well, I should mention, is they've got an MSP this year, which, well, if we'd had this meeting a month ago, I'd probably say was 10 cents below where the market was trading. It might now just be 3 or 4 cents below. But there's there's the action of CCI there implementing the MSP. There are the stocks in that India have, which reached 2 million tons, are now down below 1 million, so maybe more manageable. But CCI are just commencing their origination campaign for this year, so we're probably going to see CCI potentially taking between 30 to 50% of the of the Indian production into their certainly through their buying operations. So there's a lot of potentially market disrupting activity, which, as long as it's telegraphed, is quite easy to factor into our trading strategies and to our supply chain management. But it's when they come as a surprise that they can really cause shocks. And I mean, I think the message really for this discussion is to say that we should try and cast our mind to think about what those contingencies can be and what those policy responses can be, because you never know when they're going to happen, and you just have to kind of be prepared for them. And sometimes they can catch you off guard and be to your benefit, and other times they can very much be to your detriment. And then the last point I'm going to cover is sort of split into two. It's kind of on the general point of liquidity, and I know that Marcus also spoke about this in his kind of macro view, just about the the level of stimulus that's been given. And if we take the US as an example, I mean, they are, there was the initial CARES Act was $2 trillion of stimulus that was literally posted to people. Then there is discussion about the second stimulus package, which has always been caught up in partisan politics at the moment, but is likely to be of a similar scale. And as a consequence of this and other a few other policies, the US is running at close to a $4 trillion deficit, which is an 18% of GDP is their budget deficit, which outside of wartime is absolutely unprecedented. And so, okay, I've chosen the US as the biggest global economy, but those numbers are not particularly unusual in percentage terms. And so we've had this massive influx of liquidity into the world. And the banking systems and the physical supply chains are just really beginning to to come to terms with how to deal with this massive injection of liquidity. And on the funding of trading, there's kind of a dichotomy, because there's all this money, which means that it should be easy to access, and therefore funding should be freely available. But when we went into COVID, we had a couple of medium to large size commodity companies. Fortunately, none of the majors, but some medium-sized ones went to the wall. There was Phoenix Commodities in Dubai, which was a grain trader. There was this Singaporean energy trader, which looked like it certainly had some fraudulent aspects to it as well, but also went under, owing over $1 billion to various banks. And there's been a couple of smaller ones, I think, in the cocoa and coffee space as well. And as a consequence, you've had a number of fairly large commodity banks just basically say, okay, that's it, no more commodity financing. I think maybe the most the biggest headline one has been ABN AMRO. And so you've kind of got all this liquidity, but you're losing the sort of channels to get it into the trade finance sphere. And so I can say that Glencore's cost of funding fortunately has gone down because interest rates have gone down, but the spread over LIBOR has gone up just because the relative risk or perceived risk for commodity trading companies has gone up. And so fortunately, because interest rates are lower, that is not having an impact on margins or on the prices that we, I say we, not as Glencore, but as the trade, pass on to our customers. But it potentially could do if we see interest rates rise again. And then the second point on liquidity is just that whenever the monetary kind of pump gets turned on, ultimately those dollars have to go somewhere. And we've seen it in I hesitate to call it a bubble because I could be proved wrong, but in the equity bubble, equities just rallying by some measures beyond where economics suggests they might be, particularly in the tech sector. And commodities were a bit of a laggard, but recently, and I've run some numbers really from the beginning of May, because I'd say that was when the recovery started and when most of the stimulus packages were put into place. We've seen that a lot of that money has started going into commodities. And so, I mean, the benchmark one might be gold, because that's often seen as a safe haven. And gold is up since the beginning of May about 12%. So that's from just under $1,700 up to around about $1,900. And so if you think that's the baseline, so what have other commodities done since then? Well, most agricultural commodities are much stronger. So we've had corn is up 35%, sugar's up 33%, copper's up 34%. And we know that that cotton's up very much in line with those as well. And so, is that purely because of refilling the pipelines and the relatively resilient consumer? Quite possibly it is, but it's certainly assisted by commodities again being viewed as an investment vehicle and being a class of investment. And again, if you look at the Commitment of Traders report issued every week by the CFTC, while almost none of those commodities are breaking new records in terms of the fund participation, they're certainly all towards the top end of what we've seen historically. So if we take cotton as an example, the managed money participation in cotton is around about 60,000 contracts long. The record we've seen is 108, but that gives you some idea that it's still, it's definitely leaning to the long side, but there's plenty of potential ammunition to take us further. And I think that's, that's a little bit of a concern for us when we think about, will commodities or will the futures market continue to track with cash prices and fundamentals? So that's really my piece. There's as people who know me would testify, I'm more than happy to keep on talking and talking, but in the sake of time, I'd like to hand back to Jerry and look forward to your questions.
I appreciate that very much, Colin. I have to say, I didn't much like your last point. The combination of a large inflow of investment money into commodities, encountering a financially constrained commodity merchandising industry sounds a lot like the beginning of 2008 to me. And we all know what happened in March of 2008. Do you think there's much of a chance it could get to be problematic like that was?
I mean, I think to make that that kind of forecast it'd be very brave to do it. But I'd also say it's not completely out of the question. You know, there are certainly aspects that are similar, as you say, and in fact, the Commitment of Traders report back in 2008, it didn't have the disaggregated categorization, so it wasn't managed money, swaps, etc. It was the just commercials and non-commercials, and it's very interesting that if you look at that, the week before the market exploded in March 2008, the non-commercial, so the fund participation in our market was 90,000 contracts gross long, sorry, 95,000 contracts gross long, and about 7,000 or 8,000 contracts gross short, for a net of just under 90,000 contracts. The same report today is almost identical, and yet, from the, you know, as I just mentioned before, on the new disaggregated report, you could argue that there's at least 40 to 50,000 contracts of additional buying that the funds could add to this market based on their record lengths previously. So I think that it's certainly it's certainly something to keep in the back of our mind as a concern, and a bit like I was saying about how we trade around the unknowns of government intervention. I think that we kind of almost need to keep this as another contingency out there, and say that, you know, this is something that could happen, and, you know, we need to make sure that we have the liquidity and the margins to absorb some event like this happening. And just on that last point, I'd also say that one of the reasons why 2008 was so explosive was because of the margin call aspect of it, and also because I think the trade had also sold a lot of options, and so was short gamma. And as the market was moving up, limit up day by day, you know, that gamma was just getting uncontrollable. And the liquidity wasn't there to keep on chasing the market up. So I think the trade as a whole are better financed now, and and I think there's a bit more respect paid to being short gamma. So I would hope that it repeating itself in the same way and so explosively is a very small risk. But I absolutely acknowledge the comparison.
Well, thank you, Colin. I appreciate that. I understand we have quite a few questions. Bill, have you got anything that you think we really need to get onto right now?
If I can unmute myself. Well, we've got a number of questions for Rabonna, particularly on what protections against a second spike, and whether you think the relationships between the pillars you spoke of is going to be improved now in the experience of 2020.
Bill, I think I've answered all the questions. I typed all my answers. However, if you want me to say it again, I can. Well, I'm cautious about how the relationship between brands and suppliers will change, but I'm also hopeful. And nothing changes overnight. So, you know, our extreme dependence on the West needs to cease. We need to have more alignments with the ASEAN markets. So ASEAN +1 should be our policy. And also, you know, an inward-looking economy is going to help us. So with the second wave coming in, We are hoping that the strain is going to be weaker, and we are depending on the December sales. If we have a rough December, then I'm afraid we are probably going to be stuck with a very bad half year of 2021. And hopefully, you know, the governments, when they're imposing strict lockdowns, they'll keep retail out of it. So far, it has been the case, but we don't know for sure. With COVID, we never know what to expect. So relationships will change, dynamics will change, consumer patterns will change. So whatever we say or we hope or we expect, we're pretty defenseless against the pandemic at this point of time.
Thank you. I was struck by another theme that 2 or 3 questions have arisen in that in this dynamic market, I think, to summarize, where there's massive pressure on shifting demand at one end of the supply chain, the price of the commodity is altering up and down, but mainly down. Are the mechanisms that we've got in place for the cotton world, do they match the needs of the community at this time?
Who'd like to have a go at that one? Colin?
Yeah, I mean, I was just unmuting myself. I mean, I think that I can obviously speak much more informedly about the raw cotton side of it, and I, you know, at the risk of sounding like I'm on a ICA infomercial, I'd probably say that I think the rules do a very good job of you know, of firstly explaining, you know, what everyone's obligations are that might be unwritten on the contract, but also, you know, of strongly promoting sanctity of contract. And it's a bit like I mentioned about the sort of the asymmetry of power in the supply chain. I see the issues much further down, where there's very fragmented spinning and, you know, weaving and garment sector, but relatively concentrated retail. You know, and I think that it's at that point where, you know, the question needs to be about, you know, what does responsible sourcing or sustainable sourcing of, you know, garments and textiles look like, as compared to what does sustainable sourcing of raw cotton look like? And from everything that Rabonna mentioned and that I've heard from our own customers, you know, it appears that there's an awful lot of work to do on that front. And I think that it's also probably worthwhile mentioning that, you know, one of the big you know, forces for change in that is the consumer. And what I see as a potential positive from COVID is that if we switch from the majority of apparel being purchased, you know, in bricks and mortar retail, fast fashion kind of style, and move more towards online retailing, I think there's a great opportunity to provide a lot more information with the garment. You know, so there can be, you know, you're not just looking at, you know, feeling the quality on a hanger. You're actually, you know, looking at a website page that's got a picture of it, but then it can tell you, you know, how it's made, where it's made, you know, what sustainability programs it's, you know, it's kind of being audited by, all those kind of things. And I think that that's probably where the power is to make, you know, to make a change and to hold the retailers' feet to the fire, as I said before, to, you know, to not just to talk the talk, but to walk the walk.
Thank you, Colin. We've only got about 5 minutes left, and the one topic that I've noticed that no one has really touched on that I think is needs some discussion is the prospect of the trade sanctions against Xinjiang. The U.S. Congress last month almost unanimously passed a bill in the House The Senate is not likely to take it up until the new year, but the margin by which it passed, 406 votes in favor and 3 opposed, is almost unprecedented in the U.S. in this politically divided time. So something like that is very likely to come. And I think I want to throw this one to Rabonna, if that's all right, and maybe Marcus to comment on what, will these supply chains be able to adapt to sanctions in the West against 20% of the world's cotton? That one's for you, Rabonna.
Sorry, Jerry, I lost you completely because I got disconnected. I'm sorry.
Okay, the question was, in the event that we have sanctions from the US and Europe against Xinjiang, how readily can these supply chains be restructured to work around 20% of the world's cotton?
Well, now we cannot really sort of ignore the fact that we have overdependence on cotton sourcing. But at the same time, world gets used to it, and local capabilities are also growing. At one point in Bangladesh, we literally had nothing, no backward linkage. Now we are quite out there. So I think drastic measures require overnight remediation. And, I don't know what's going to happen, but hopefully the world's gradually getting ready for this also. I think there's a gradual preparation set in place, and hopefully, we should be able to cope with any such sanctions. But then again, Jerry, it takes a lot of time to also adapt to changes, and it takes a lot of time to also implement changes. So I'm not sure where we are going to be going forward because it's very uncertain. The global scenario is completely uncertain at this point of time, so we can't really pinpoint fingers and say exactly where we are going to be and how prepared we are going to be. Nobody has any answer for that.
Thank you. Marcus, with your degree in modern Chinese studies, do you have anything to throw in on that?
Not on the cotton side. I'm afraid not my area of expertise, but I think one of the things that would be a challenge, I should say, if you do have anything that disrupts that supply chain in other markets, is sort of establishing provenance and whether you actually see things that also just result in trade being reordered rather than kind of ultimate changes. Because in the metals markets, for example, Xinjiang is a large producer of aluminium, also in the bulks market, it's a very large producer of coal, but the vast majority of that is consumed by China domestically. It doesn't trade internationally, but there are some export flows. So I think it would come down to really how you see people making substitutions between where they're getting material from, rather than something that in the markets that I follow would have a huge impact. I think one separate thing that actually just might be of interest to people is, I didn't really go into it, but Colin mentioned on kind of financial activity in grains markets, mentioned gold. This is a theme really across all of the metals markets as well, that while you can, I think, debate how strong a fundamental recovery has been, there are clearly a number of candidates where investor length is, as you say, quite similar, actually not super stretched, but is very long by historical kind of norms. In fact, in pretty much every single base metal, that's the case as well. And I think there are ones where you could make the case that the financial side has pushed the market further than the fundamentals might justify. But we could have a whole nother hour session to debate the various merits and issues with that.
All right. Well, unfortunately, but our time is up. We have a 1 o'clock finish, and it is 1:01, I believe. I want to say thank you very much to the panel for taking the time to participate in this today. The comments have been extremely interesting and topical and timely, and I appreciate that. Marcus, especially appreciates your participation as an outsider. It's an interesting perspective to hear what's happening and how similar some of the other markets are to ours. With that, we're going to wind up. Thank you to all the panelists. Thanks to ICA. And it will be 30 minutes from now when we kick off the next session. So please come back soon. Thank you. And that's the end of this.